What's up, everyone? Welcome back to the channel. Let's have a discussion today on cash value life insurance. I know, give it to me. Listen, I'm talking about cash value life insurance because I feel like there's a massive lack of good quality information out there for consumers, business owners, high net worth individuals, that your financial advisor is financially motivated for you to not do life insurance. For whatever reason, they have an aversion to life insurance, and maybe it's not their fault. Maybe it's that they got into the financial services industry and whoever taught them financial concepts didn't really understand it. But there is a massive gap of knowledge. The uber wealthy and their financial advisors understand the importance of life insurance, and they're buying life insurance as fast as they can because they understand what's coming down the road from a rising income tax environment, rising estate tax environment. They understand the power of compounding interest, and they get that. But when you get into middle America and hardworking Americans, for whatever reason, life insurance has a negative connotation. So in this video, I'm going to talk to you about the benefits of cash value life insurance. Make sure you like, comment, share, subscribe. Send this to your financial advisor. Send this to your brother-in-law who just got into the insurance business. Send this to your loved one that you care for because they need to understand this. You need to understand this. And I feel like I'm equipped to give you this conversation. So let's talk about how much coverage. Life insurance is a want rather than a need. In fact, it is the only product that will guarantee that what you want to happen in the event you are not here will happen, assuming you have life insurance. If you went with your financial advisor's recommendations, you won't get life insurance. So we need transportation. You need transportation. So you could use a bus, right? Which is the cheaper method of transportation, or you could decide you need a car for yourself. Right? That is one of the examples of needs versus wants that we deal with on an everyday basis. Then was your house purchase a need purchase, or was it more of a want purchase? Did you buy just enough house that you needed? Or did you buy a little bit more house so you could grow into it, so you could have a little bit more space? Was it not just about a roof over your head and a bed to sleep in, or was it more about having something comfortable that you wanted, not needed? And then there's the educational opportunity for our kids. Do we only send them to public school, or if we have private school as an option, do we want to send them to private school to give them a better education, right? Needs versus wants. So let's talk about this because it'll all come together here in a second. Policy proceeds. Let's assume for a second that you've already done a little bit of work and you have a $500,000 death benefit policy. Let's say you've already saved $88,000. Let's say you can earn 5% on your money when it's invested with your financial advisor or on your own. And let's say you require $102,000 a year, and we're going to assume inflation is 3%. Well, in that example, your $500,000 plus the $88,000 at a 5% investment return would be exhausted in 7 years from your $500,000 investment if you died. So your loved ones would only get that for 7 years if you passed away. So how much could you get? If you're 42 years old, your current income is $142,000. The industry right now, the average in the industry, you can get $2 million of life insurance coverage. That's 20 times. That's a 20 times multiple on your income. And if you're under 40, it could even be a 30 times multiple on your income. Think about that. That's what the industry is saying is what you would qualify for. But yet Dave Ramsey and Susie Orman is out there saying, all you need is about a $250,000 term insurance policy. By the way, I did a video on buy term and invest the difference. You should watch that video right here so we could talk about that. So how much is enough? How much income is enough to achieve what you want? So if you wanted your money to last your entire life cycle into your life expectancy, you would need about $3 million. So that's $1 million more than what you can already get of $2 million. So there's already some issues that we would have to deal with in this example. Let's summarize this coverage for a second. Your maximum coverage that you can get is $2 million. Your current in force is $500,000. What's needed in reality is $3 million. So that's a $2.5 million shortfall in coverage. How much do you want? How much does it cost? So let's talk about that for a second. And you've all seen me do this video before. It's the 10-minute lesson on life insurance. If you haven't seen that video, make sure you watch it. But I'm going to go through some of that right now. So there's a minimum amount you can pay for any given amount of insurance, and that's called term insurance. There's also a maximum amount that you can pay for insurance, and that's set by the government. The minimum premium is determined by the insurance companies. The maximum premium is determined by the federal government. In between the minimum and the maximum, there's an unlimited number of design options, premium options, funding options, that we can design a product or a structure that makes the most sense for you. The reason why there's a line on the top end is because in the TAMRA-TEFRA tax law change of the 1980s, the government decided to finally bring in the introduction of qualified plans. And qualified plans are your 401ks, your IRAs, your 403bs, your SEP IRAs. And they wanted to make sure more money started getting into the qualified plans than was going into permanent life insurance. There's some basic similarities and there's some differences. So on a qualified plan, contributions are made before taxes. In a life insurance policy, premiums are paid with after-tax dollars. In a qualified plan, the government limits you on the contributions. In a life insurance policy, there's no limit on the contributions so long as we get the size of the policy right. Tax-deferred growth in qualified plans, tax-deferred growth in life insurance, all proceeds from qualified plans are 100% taxable. Death benefit proceeds from life insurance policies are income tax-free, as well as 10% penalty on early access to qualified plans if you're before the age of 59 and a half. They penalize you to get access to your own money prior to age 59 and a half. But in life insurance policies, you can get access to your account values at any age, income tax-free via loans. And we talk about that. Policies with premiums above that limit right here are called a modified endowment contract. And then the distributions from those are treated like qualified plans. Taxable as ordinary income to you on the gains. And while we're talking about qualified plans for a second, let's talk about what qualified plans do. Remember, like, comment, share, subscribe to this channel. Qualified plans do two things. They defer the tax and the tax calculation. A more accurate statement would be that they postpone taxes and the tax calculation. So the first question you need to ask yourself is, what tax bracket are you going to be in retirement when it's time to start withdrawing the money? I've got a whole nother video that I'm doing research on and prepping to do right now. AllianceBernstein just did a massive study about, the national debt and the amount of government spending and deficit that we have, and what are the solutions? Medicare, Social Security. So what are we going to do with this impending financial crisis that we're facing as a country? And everything comes back to raising income taxes. Taxes are definitely going up. The second question you have to ask yourself is, when you are older and retired, what deductions will you have? Your house is paid off, your kids are gone, they're off the payroll. So you don't have the mortgage deduction anymore. You don't have the child deduction or the child tax credit anymore. You're probably not, self-employed anymore, so you would lose any of those deductions. So what are your deductions going to be as you get older? So again, let's go back to this $500,000 example. Let's assume you want to purchase $500,000 worth of life insurance. The minimum payment, let's say, is $500. The maximum payment, let's say, is $10,000. If you paid over that, it would become a modified endowment contract. Now, which one of those looks more attractive to you? Well, the lower premium coverage is called term insurance, and it's only there for a death benefit. And I also did this video. You should watch this one, Buy Term and Invest the Difference. But less than 2%, some studies less than 1% of all term insurance policies have ever paid a death claim. That means 98 to 99% of all term insurance premiums that the insurance companies receive every month, every quarter, every year, they're never going to pay a death claim on, because most people cancel their term insurance, or most people die after the term has been completed. These insurance companies know what they're doing when it comes to that. Well, let's forget about insurance for a second. Let's talk about the benefits of what we want our money to do. When looking for a place to put your money, it makes sense to look for the most possible benefits, right? And if you could wave your magic wand, what would those benefits be? Well, I'm guessing one would be tax-deferred growth, tax-free distributions, competitive rates of return on your money, high contribution limits, put in as much as you want, additional features and benefits, bells and whistles, the ability to use the account as collateral for future loan purposes. It's safe, It's got some no loss provisions. You're guaranteed to take a loan from it or get access to your money whenever you wanted to at any time. And you could pay the money back into your account if you chose to at your pace, at your leisure, whenever you wanted to. You had liquidity, use, and control of your money whenever you wanted it. And you would have deductible contributions. I mean, correct me if I'm wrong, but I think those are 13. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12. Those are 12 characteristics. Would you not agree with me? If you had all of those, you would have the perfect place to put your money, right? Well, let's get back to life insurance for a second. When we hear the words life insurance, we tend to think about getting the most coverage for the least amount of cost. That's what many people think of when they think of life insurance. But the reality is the most efficient contract you can design, the best place you can put your money, according to those 12 characteristics that you wanted for your money, when you properly fund a life insurance policy up to its maximum possible limit, up to that cash value life insurance limit that the government created, you're creating a maximum efficient contract for your money that nowhere else can give you the same type of tax treatments that this provides. The only benefit cash value coverage does not offer, according to the list of ideal characteristics, are the tax deductible contributions. Life insurance policies offer the maximum amount of benefits and perform at their maximum potential with premium up to, but not over, the government allowed amount. We call those maximum efficient contracts. What about access to capital, right? So how much do I need? How much does it cost? What about access to capital? And there's two reasons to take money out of your life insurance policy via the loan. One is for a major capital purchase, and the other one is for an investment opportunity. And we've got these coming at us all the time, so let's talk about it. So when we want to use it for our major capital purchases, this is what the economic flow of money is. You've got your income that you're earning over here. This little diverter right here is for income taxes. The rest goes up here for future lifestyles. And we're diverting it into the cash value bucket to be used at a future time. Our goal is this car. That's our major capital purchase. So what we're going to do is we're going to take a loan against our policy. We're going to borrow the funds from the life insurance company using our cash value as collateral that we built up. And as we continue to earn money, we will still continue to divert money into the policy via savings, but we will also divert money into paying ourselves back for the car. Just like you would pay back the finance company that you used to purchase the car, you in essence became the finance company, you're gonna pay yourself back, right? And by doing that, you're creating more collateral capacity for future purchases, for other major capital purchases, whether it's a more expensive item or more items that you want to do. Well, what about for investments? Same concept for investments. We're going to divert our income into building up our cash value policy. It takes time to capitalize this, depending on your situation and how much money we're putting in on a monthly or annual basis. But then you've got the opportunity for an investment, right? And let's say that investment is a house and you want to use it for an investment house. We can divert the money by paying that back, and that gives us the ability to purchase that house as an investment opportunity. And we have that same internal buildup, right? The same concept works. We're going to use it to increase our collateral capacity. And by doing that, you are able to create more of an investment opportunity for yourself as time goes on. So let me finish up by saying this. Here's how it would work. Right? We want either the money for major capital purchases or we want the money for investments into something in the future. We're going to use our cash value as collateral. We're going to borrow the money from the insurance company and they're going to loan it to you at an interest-only loan. And you're going to be able to pay yourself back for that major capital purchase or that investment, for the use and control of that money. And those loan payments are non-structured. You get to pick the terms and the rate on which you want to pay yourself back. But by doing so, cash value life insurance, when designed and utilized properly, can provide stable growth, cash value collateralization, guaranteed loan access, no annual tax on the growth and death benefits. And then those additional benefits are available within the additional policy riders, features and benefits, things like that. So how much coverage do you need? How much does it cost? And what about access to capital? Like, comment, share, subscribe. See you in the next video.